look, in a way, it's probably not appropriate for me to give great predictions, but what I said a couple of weeks ago was that there was a better than 50% chance that Greece would default. I stand by that view, and if that takes place, then obviously that will have some implications. I mean, what the rating agencies are telling all of us is that we just live in a lot more volatile times, and ultimately that will have some impact. But I'd say the markets have priced a lot of this, and it's not exactly something that completely surprised me.
Cost of living pressures, though, are going to rise, aren't they, with the dollar fall?
It's a double-edged sword, as I've often said. When the exchange rate went up, and there was a lot of pressure from exporters. On the one hand, as we always said, there's a big imported component about petrol and other food prices. So when the exchange rate goes down, it's good for exporters. It's bad for the rest of us when we're consuming imported goods. It's a balancing act. I mean, the New Zealand dollar above 80 cents is always a little high, so at these levels, it's still at reasonably attractive levels from an import perspective.
Do you expect much impact on mortgage rates for Kiwis in terms of higher borrowing costs overseas?
That is the factor that arguably is more likely to have an impact, but we live in quite unusual times at the moment. I mean, one of the things is, even though our rating has been downgraded a notch, we're, relatively speaking, from a sovereign point of view, a very attractive country to still invest in, and so actually capital's been flowing in. I mean, what is also at play here is ultimately what happens to the banks, and whether the Australian banks are downgraded.
Will the government pull back on its borrowing, given that it had been sort of front loading a bit if it becomes more expensive?
We're in pretty good shape. We've gone from borrowing basically $300 million a week to now under $100 million a week. So our borrowing requirements are relatively light now. I mean, the deficit is halving this year and halving the year after. After that, it'll be gone. So actually, to be honest, I think we've, from that perspective, managed that position very well. We've funded as much of our requirement as early as we can at very attractive rates. So we're in the best shape we can be, at least.
Just on the credit rating downgrade, you kept on saying that the ratings agencies indicated to you that the government debt should not be more than 30% of GDP. Did they give you a number on sort of where they thought the nation's total debt should be, just the public and private debt?
Well, they've always been worried about our private sector debt. So the net external liabilities is of concern to them. It's of concern to them in Australia as well. I mean, we're currently sitting at 69% of GDP. Australia's sitting at 55% of GDP. So they are worried about the wholesale funding in the international markets. And as I say, and if you go and have a look at their statements, both Fitch and S&P basically say one of the strengths of New Zealand is the Crown balance sheet. But the really important point there is we need to restore that balance sheet in a healthy position as quickly as we can. That's why we're so focused on keeping that surplus.